Did you know that even today in America, millions of people keep their entire life savings in a bank savings account, believing their money is completely safe? But the truth is far more surprising. Hello, everyone, and welcome back to another eye-opening episode that could completely change the way you think about money. Today, we're going to talk about a financial reality that most people never take the time to truly understand. Even in a developed country like the United States, millions of people go to work every day, pay their taxes, cover their bills, and deposit whatever is left into their bank accounts. They believe that this is the smartest thing they can do with their money. But have you ever stopped to think about what actually happens to your money after you deposit it into the bank? The reality is that your money does not simply sit quietly inside a vault. Banks take that money and lend it to large corporations, real estate developers, business owners, and investors. Your money goes to work. The bank earns significant profits from that money.
And what do you receive in return? Often just 1%, 2%, or sometimes 3% annually. In other words, the money you spent thousands of hours earning is often working harder for the banking system than it is for you. But the story doesn't end there. There is another silent force, steadily reducing the value of your wealth. Its name is inflation. Over the years, inflation has reduced the purchasing power of savings for millions of Americans. The goods and services that could be purchased with $100 a decade ago often require significantly more money today. This is why saving money and growing money are two completely different things. If your money is not growing faster than inflation, your wealth may actually be shrinking in real terms. Many people believe they are playing it safe.
But sometimes the greatest risk is the one people mistake for safety. Now, imagine a different scenario. Imagine your money working for you. You are sleeping and your money is growing. You are on vacation and your money is growing. You are spending time with your family and your money continues to grow. This mindset is one of the biggest differences between financially independent people and everyone else. Wealthy people do not rely solely on trading their time for money. They build systems that continue generating income even when they are not actively working. They acquire assets that become stronger and more valuable over time. And today, we're going to explore some of those powerful assets. But before we do that, let's understand one very important concept. What is the difference between an asset and a liability?
In simple terms, an asset puts money into your pocket. A liability takes money out of your pocket. Every year, millions of Americans make a costly financial mistake. They confuse liabilities with assets. For example, imagine someone purchases a luxury vehicle simply for status and appearance. The car costs $80,000. There is a down payment, there are monthly payments, there is insurance, there are maintenance costs, there are fuel expenses. Now ask yourself this question. Is that car putting money into your bank account every month? No.
In fact, it is taking money out of your bank account every month. That means it is not an asset. It is a liability. This is where many people go wrong. They increase their expenses first and then try to increase their income later. Financially successful people do the opposite. They build income-producing assets first. Then they use the cash flow generated by those assets to pay for the things they want. That difference in thinking can completely change a person's financial future. So without wasting any more time, let's begin with the first powerful asset. Number 1, real estate. Real estate has been one of the most popular wealth-building tools in American history. The reason is simple. Population can grow, housing demand can increase, but land remains limited. Cities such as Manhattan, Miami, Austin, Nashville, and Phoenix have experienced significant property appreciation over the years. A property purchased in a strong location can provide benefits in two ways. First, the property's value may increase over time. Second, it can generate consistent cash flow through rental income. That is why many millionaires and wealthy families around the world hold a substantial portion of their wealth in real estate. However, many people assume that real estate investing is only for the wealthy. That is not entirely true. Today, through real estate investment trusts, commonly known as REITs, everyday investors can gain exposure to large commercial real estate projects without purchasing entire properties themselves. So far, we've learned that saving money and growing money are two very different things. And as you will discover throughout this episode, building long-term wealth is not about how much money you earn, it is about how many assets you own and how effectively those assets work for you.